Do you want to make serious money in crypto? I'm talking life-changing money. Not 5K, not 10K, I'm talking 6 to 7 figures. You do? Keep watching. If that's your goal, there's one thing you need to understand above everything else. Not tokenomics, not chart patterns, not which L2 has the best TPS. It's macroeconomics. I know how that sounds, macroeconomics. It probably takes you back to the classroom or a textbook or someone droning on about GDP and imports and exports. It wasn't overly complex, but it felt really disconnected from the real world. And I know most people, especially in crypto, have been looking for an alternative to traditional finance. And you would rather skip macro completely, focus on the charts. But after 8 years in the space, I can assure you there's a clear pattern amongst the most successful investors I know. As they consistently make money due to their knowledge of the macro environment. It's not just about catching one cycle. Those who win time and time again, whose wins compound and predict their gains, and they come out on top, those people understand macro as good as anyone. And the people who don't, they might have a good cycle, they might make 5 or 6 figures, but very rarely do they keep it. The issue as well, whether winning or losing, they never quite understand why or how, and they're always one macro move away from losing it all. Here's the thing though, macro isn't something you learn. There's not some brilliant course that's going to teach you macro in 6 or 7 hours. It's not something you tick off a list. The only way you truly learn macro is by living it every single day, watching it unfold in real time, seeing a CPI print land and watching how the market reacts. Slowly over months, over years, over cycles, building the pattern recognition that turns raw information into a genuine edge. You can't live it if you don't understand it. And that's what this video is for. Not a course, but a masterclass. The goal isn't to make you a macroeconomist or give you some sort of qualification. It's to give you the vocabulary to understand the concepts and the frameworks, so when you're watching macro unfold in the real world, you understand what's going on. You know what it means for your portfolio, and you can start making calculated decisions around that. In today's masterclass, we're going to cover the 2 forces that drive the global economy, the relationship between interest rates, the job market, and inflation, global liquidity and the meaning of risk on and risk off. We'll walk you through the perfect macro environment, the worst macro environment, and the current environment we're in right now. And I'll give you a practical guide that you can use every week, every month to assess the macro picture to make actionable decisions for your portfolio. I will warn you in advance, this video is dense, but many people tell me to break this up into parts. I've decided to put it all in one place. So if you haven't got much time, save it, download it, and use it as a type of Bible to refer back to. I urge you to take notes. I urge you to download, and I urge you to follow up and ask any questions you have in the comments below. Without further ado, let's build your macro foundation. Disclaimer, before we get into this, I want to make something crystal clear. I'm not a macroeconomist, I'm not a financial advisor. I'm an investor who spent many years watching how macro has shaped the crypto markets, including watching it move against my own portfolio and positions. Someone who understands that this is not optional if you want to protect your wins. Understanding that this isn't something that's optional if you want to win and keep your gains. This is education. Use it to ask better questions and make better decisions. And look, macro evolves. The frameworks we cover here are durable, but the specific numbers and current environment are relevant as of Q2 2026. So if you find this in 2028, it's best to get up to speed. Over my years in the market, I've seen the same story play out time and time again. People have a good cycle, they make a lot of money. We can be talking hundreds of thousands of dollars, but they never truly understand why. They feel incredible, invincible even. They attribute their success to their genius, or understanding fundamentals better than anyone else, or they're a technical wizard, or they just know what makes a project work. They start sizing up positions, they encourage friends to get in, and then the macro environment shifts. This isn't about hitting the jackpot on day one, it's about building wealth over time. Fed starts hiking, the dollar starts strengthening, global liquidity starts contracting. All the signals are there in plain sight, but they miss it because they're missing the forest for the trees. They're focusing on the small things, not the big things. Micro thinkers versus macro thinkers. No one in their feed is talking about it. All the discords are still bullish. The projects are still building. The fundamentals haven't changed. They may be in fundamentally sound projects and they may be great, but when macro shifts, no one is prepared. 12 months go by little, the market bleeds. They watch 80% of their portfolio go down, but they don't understand why. They think it's a passing trend. They think it's a shift. And the truth is, they weren't being reckless. They weren't stupid. They didn't pick bad projects. The environment just changed and they were none the wiser. And why? They didn't understand macro. And even if they did, they didn't start living it. This video starts that process. Let's build that foundation together. Okay, now let's begin. Before we get technical and into any indicators or signals, we're going to go macro and help you understand the big picture. There are two forces at play that control everything. They run everything in the global economy. Every major macro development comes down to these two forces. Every development, every rate decision, every market crash, every liquidity cycle traces back to one or both of these two forces, the government and the central bank. They operate completely independently, and we're going to discuss why later. And they have different tools for how they manipulate the market. They sometimes work together and sometimes against each other. And understanding the relationship between both and their roles in the economy will help you interact with macro on a daily basis, and is the absolute foundation of everything we cover. Let's take a look at them one at a time. The government influences the economy by what economics called fiscal policy. This is basically how much the government spends, how much it taxes, and how much it borrows. Write that term down. Fiscal policy. It's critical. Government spending and taxation are the tools government use to influence economic growth. When the government spends on infrastructure, on stimulus, on public services, money enters the market. People spend it. Businesses make it. Growth follows. When it needs to fund that spending, it increases taxes. When the government needs to fund that spending beyond what taxes bring in, the government borrows. Now, the way the governments borrow is different to me or you. They do this by a tool called bonds, which is something you've probably heard a lot about. Understanding bonds is critical to understanding fiscal policy because they affect everything from interest rates to global liquidity to where investors decide to put their money. So let's dive into bonds. Think about bonds as IOUs, meaning I owe you some money, a written promise from the government to pay back investors at a given time. And while they do that, they'll be paying an interest for holding the bond. You lend them money today, your money sits there, and they'll pay you an interest on it, and you get it back later. Think about this like a bond as an agreement between two people, like a type of handshake. These bonds are also known as treasury bonds or T-bills for short. They are the government's number one mechanism for issuing debt. The interest rate on these bonds are called the yield. This is one of the most important numbers in all of finance. So let's define it clearly. The yield is simply the interest, the annual return an investor gets for holding the bond. This is expressed as a percentage of what the bond is actually worth. If you buy a bond for $1,000 and it pays 5%, you're getting $50 on that bond per year. That's it. Very simple. It's a return on the investment. Now, here's where yield is very important and why it moves. A bond is an asset like any other asset and is affected by supply and demand. When lots of people buy bonds, demand is high and price goes up. However, the relationship between the yield and the price is inverted. So the more demand and price goes up, the lower the yield. More demand equals higher price, lower yield. Less demand equals lower price, higher yield. Just always remember they move in opposite directions. Here's why that works mechanically. The payment the bond makes every year is called the coupon. It's fixed at the time of issuance. It never changes. So if you paid $1,000 for a bond at 5%, you get $50. But if that bond goes up in demand, the $50 you earn stays the same, which means the interest you're earning on that bond is lower. The same £50 and the value of the bond is now 4.2%. Obviously, less appealing to hold. The yield falls because the fixed coupon is now smaller in comparison to the original price. The yield fell because the fixed coupon is now smaller in relation to the higher price. The coupon stayed the same, the price of the bond didn't. So the yield moved down in the opposite direction. Now, here's why that matters. When we talk about money moving into bonds, this typically isn't coming from retail investors. This is coming from institutions. This is coming from pension funds, central banks, insurance companies, giant entities that control the world. These are trillion-dollar pools of capital. Retail investors have no interest in this. They have a much smaller role to play in these markets. This matters because when these institutions move, the whole market moves. And the biggest institution in the world is the US government. The US Treasury market is the largest and most liquid financial operation in the world. Larger than the US stock market, larger than the Chinese market, larger than any single equity market in the world. Daily trading volume runs into the trillions. That's why the bond market, and keep an eye on the yield, is such a powerful signal. It's not a niche indicator. It's the price of money in the deepest, most liquid market in the world. People, and more specifically institutions, buy bonds when uncertainty is high, when they're scared, when a recession looks possible. When a market shock hits, that's when money flows out of other markets into bonds. It's almost like a guarantee, a hedge against the chaos. But to understand this, let's take a look at why bonds are considered safe in the first place. The answer is simple. US Treasury bonds are backed by the United States government, and the US government has never defaulted on its debt in the modern world. It can raise taxes, cut spending, or in worst case, just print more money to meet its obligations. That implicit guarantee is what gives bonds demand, especially in turbulent environments. And ultimately, it's a benchmark that every single investment must meet or outperform for it to become worth it. When investors say they're risking off or moving into safe haven assets, they're talking about bonds. So when uncertainty hits, recession risk is up, a banking crisis, a geopolitical shock, institutions sell everything else and buy bonds, which means price of bonds go up and yield in comparison goes down. So when you want to gauge how institutions feel and investors as a whole, keep an eye on the yield. Higher yield, people are more risk on as price went down. Lower yield, people are scared, they're tense, they buy bonds, yield drops. So in simple terms, if we're keeping an eye on bond yields, if yields are going up, that means people are more comfortable in risking on. So when you see bond yields falling sharply, that means people are scared, they're not going to invest. Crypto is an extremely risky asset. So when bond yields are falling, it means people are selling the likes of a crypto to buy bonds. And then there's the inverse. When yields are rising, it means people are selling bonds, which means they're willing to risk on, and they're more likely to buy something like crypto. So when you see yields rising, it's a sign that, hey, crypto is probably going to go up too, because people are selling their bonds, and vice versa. Bond yields dropping, people have probably sold their crypto to buy bonds. Now, if you can figure out where we're on the spectrum, where we're headed, you get a good idea if money's going to flow into crypto or flow out of crypto. Look, with crypto being a 24/7 market compared to the likes of the stock market, well, you can see how, especially in times of extreme uncertainty, perhaps with chaos over a weekend, the first thing people do who have money in all assets will sell their crypto as a hedge. You're seeing it right now with the chaos between the US and Iran. Every time Trump comes out and makes a crazy statement, the crypto market sells off on a Saturday because people can't go in and sell their stocks. To summarize that key point, a rising bond yields mean demand for bonds is lower, people are more confident, and they're willing to invest. This is typically a good sign for crypto. Same the opposite. Bond yields going down, it's a signal that demand for crypto is dropping and prices are probably going to head down. There's one more dimension for bonds that's important you understand, and it affects every risk asset, including crypto. When bond yields are high, say 4 or 5%, investors have very little reason to invest in other assets, because very rarely can an asset outperform 4 or 5%. That creates what's called the hurdle rate.
Why would someone choose stocks or crypto to get 7 or 8% if bonds are already getting 5% with very little risk?
The bar for risk assets rise as the hurdle rate goes up. Investors have to be genuinely confident that stocks or crypto will meaningfully outperform and take any risk at all. High yields don't just attract capital to bonds, they raise the standard for every other asset out there. And that is a direct headwind for assets like crypto. You don't need to watch bond yields every single day, but knowing what a move in yields signifies for crypto, fear coming in most cases if bond yields are going down, gives you a very crucial piece of the macro picture. Let's dive in a little deeper for what this means for you as a crypto investor. When the government spends aggressively, let's say COVID 2020, they gave out a stimulus check. And heck, we may see it again because of the chaos in the Middle East. Money floods into the system. That's rocket fuel. More money being injected into the market, more money flowing, more money being spent, more money being earned, more money to go into speculative assets. When people pull back on spending and the government stops spending as much, the opposite happens. It's a reverse game. And now here's where it gets more important. When the government spends more than it collects in taxes, which is almost always has a gap to fill. That gap is called the deficit. And to fund it, the government issues more bonds, more of these IOUs, more debt sold to investors. That matters for two reasons. Because as they issue more bonds, the relationship between supply and demand changes. Because even if demand stays the same, supply has gone up, which means the price relatively has to drop. As the price drops, yield increases. Rising yields means higher borrowing costs across the entire economy for businesses, for investors, for households, and it increases attractiveness for bonds, which, as we discussed, is negative for crypto. There are absolutely many cases, and I've worked with a lot of very wealthy investors who play the game of rotating crypto to bonds and vice versa. And especially in tumultuous times like now, we're seeing a lot of money flow out into bonds. Second, the sheer scale of ongoing government borrowing keeps money circulating in the system, and the US national debt now sits higher than any other country, above $36 trillion. That deficit runs into multiple trillions annually. So let's summarize, because on the surface, it does seem contradictory. More government spending pumps money into the economy. That's good for liquidity, good for risk assets, good for crypto. Funding that spending by issuing more bonds affects the supply and demand ratio, which increases yield of bonds, which means people are more incentivized to invest in bonds, which means, hey, crypto really has to perform to get over that hurdle rate for people to decide to move their money into crypto. The net effect typically depends on the context. Why is the government spending? Why are they issuing new bonds? Is the economy struggling and is a recession on the table? Or is this something just used to stimulate more economic growth? And crucially, something we're going to get onto is what is the Fed doing at the same time? Are they cutting rates? Are they running QE? If the government is stimulating and the Fed is cutting and QE is happening, that's typically very bullish for crypto. The liquidity injection wins. The money flowing in the system overwhelms the bond competition. Like in 2020, we saw in COVID. Then you have the opposite. When the economy is already running hot and inflation is already elevated, and the government is still spending heavily and issuing bonds at scale, yields rise, the Fed has to keep rates high too to fight inflation, to fight the inflation that's actually being caused by the spending. The competition between bonds and risk assets heats up and intensifies. That's a headwind for crypto. So they work in opposite directions. That's what we're dealing with right now, and why things are so dangerous as of Q2 2026. Inflation up, job market down, political chaos continues. The simple rule of thumb here, if the government is spending alongside a loose Fed policy, bullish. If the government is spending while the Fed is tightening, the very first thing to feel it will be crypto. This is why you can't look at the government and the Fed independently. You always have to look at them both together. And now, speaking of the Fed, let's go there next. Okay, we spoke about fiscal policy. Now let's take a look at monetary policy. If fiscal policy is what the government does with money, which is spending, taxes, etc., monetary policy is what central banks choose to do with its money, specifically how much of it is in the system and how expensive it becomes to borrow. The central bank of the United States is called the Federal Reserve, in short, the Fed. And because the US dollar is the world reserve currency, it's the most used for global trade and debt is priced in it, the Fed is essentially the central bank of the world. Its decisions affect London, Tokyo, Dubai, absolutely everywhere. And now specifically, the Fed exists to do two things, and they are formally known as the dual mandates. First, stable prices, meaning keeping inflation around 2%. And second, a stable job market, meaning maximum employment, keeping as many Americans in work as possible. These two goals are often in tension. Fighting inflation usually means slowing the economy. Prices are too high, and in order for people to drop prices, they need to be less profitable. They need to have less money. Unfortunately, doing this can often increase unemployment. Supporting employment usually means stimulating growth, but naturally, as growth happens, businesses make more money, people have more spending power, and they can spend more, which increases inflation. So the relationship between inflation and the job market is very tumultuous, and the Fed's goal is to constantly balance these two things. And how the Fed chooses to manage this determines the macro environment for everything else. The Fed's primary tool is called the federal funds rate. This is the interest rate at which banks borrow money to one another. Think of it as the price of money at the wholesale level. Everything else in the financial system, mortgage rates, credit card rates, corporate borrowing, takes its cue from this number. When the Fed raises its rates, money becomes more expensive to borrow. When it lowers, money becomes cheaper. That's why we talk so much about rate cuts and rate hikes. This number is probably the most important metric to focus on across the entire financial system. The simple act of hiking or cutting rates dictates the whole economy. And here's the mechanism of why it matters for your crypto portfolio. When rates are high, borrowing is expensive. Companies slow investment. Consumers pull back on spending. And crucially, people who might have put money into speculative assets like crypto now have a genuine, safe alternative. Why invest in crypto if you can put your money in a savings account and earn a guaranteed 3-4%? It's kind of the same effect as bonds. So this increase in interest rates means money flows out of crypto into these safer assets. Crypto suffers. When rates are low, it's the opposite. Borrowing is cheap. Safe assets yield almost nothing. Investors go searching for higher returns in stocks, in real estate, and in crypto. Capital floods into risk assets and crypto thrives. Imagine you had 50K in crypto at the start of 2022. Good projects, reasonable diversification, you felt confident. Then the Fed started hiking in March 2022. By November, Bitcoin was down around 75% from its peak. Your £50,000 was now worth around £15,000. £40,000 gone. Not because any fundamentals changed, but because the Fed chose to hike rates. Rates moved from nearly 0% to 5%, and it was eating your portfolio alive the whole time. And let's be honest, you weren't watching, you weren't paying attention to these things. You were focused on narratives and technicals and fundamentals, but none of those mattered because of the interest rates. And now here's the other side of the story. In late 2023, the Fed signaled it would start cutting rates. Cuts were coming. Bitcoin sat around $16,000 at its bear market low. By March 2024, it was above $60,000. By the end of 2024, it crossed $100,000 for the first time. Investors who understood what the pivot signal meant and positioned ahead of it captured most of the move. Investors watching Discord were sitting on the sidelines and missed the move entirely. That is a real-world difference between understanding monetary policy and ignoring it. Beyond just setting rates, the Fed has another major tool. When rates are already nearly zero and more stimulus is needed, the Fed can directly buy assets, primarily government bonds, from financial institutions. Banks and institutions sell their bonds to the Fed, and in return, the Fed credits their accounts with newly created money. That's what they mean when they say printing. The Fed is essentially conjuring money into existence by purchasing assets. This injects money directly into the financial system, pushing yields down because the Fed is buying bonds. As we keep going back to, relationship between price and yield when it comes to bonds. As yield prices are pushed down, people are happy to sell their bonds and go into other assets. This process is called quantitative easing, or QE for short. QE is money creation at scale. This is the money printer. It's not a literal printing press, but the digital creation of new money through asset purchases. The effect is the same, simply more money in the system. Now, here's a chain that links directly to your portfolio. The Fed creates more money by buying bonds. Banks now have more cash than they need sitting in reserve. That cash gets deployed into loans, into investments, into financial markets. Yield on safe assets like bonds goes down. The Fed is buying them aggressively, which means investors can't get decent returns anymore, so they look to outperform. As we said before, this is real estate, this is equities, and at the ultimate level, at the ultimate end of the risk curve, crypto. QE doesn't just increase the money supply, it's actively pushing investors away from low-risk assets into high-risk assets. It's almost by design. It's a mechanism that drives capital directly into crypto. When the Fed ran massive QE programs in 2020 and 2021 due to COVID, they were buying over $120 billion of assets every single month. It's the primary reason liquidity flooded and markets went crazy. That's what fueled the crypto supercycle. Bitcoin's move from 4,000 to 69,000 happened in that same window. That's not a coincidence. The reverse, as you can guess, is called quantitative tightening, or QT. This is where the Fed allows bonds on its balance sheet to mature without reinvesting, or actively sells them back into the market. This removes money from the financial system. The banks that bought those bonds back have less cash. Less cash means less to deploy into investments. Less investments flowing, less loans given, everything becomes more expensive. And ultimately, this just means less money flooding to the normal guy and less money flowing into crypto. Think money printer for QE and paper shredder for QT. And once again, going back to bonds, as QE pushes yields down, QT pushes yields up. And once again, that affects the relationship between bonds and crypto. Investors who might have been in crypto now see bonds as more attractive, and capital will rotate towards safety. In 2022, QT amplified the damage from rate hikes. Not only was borrowing more expensive, there was simply less money in the system, full stop. The paper shredder was running at full speed while the money printer was off. There was no balance, and crypto felt every bit of it. So that's what the Fed does. But just as important as what they do is how they say it. In a world where everything is a show, in the world of stage, there may be no greater performer than our friends at the Fed. Meet the Federal Open Market Committee, or the FOMC, the group within the Fed that sets rates. They meet around 8 times a year, roughly every 6 weeks, and every single meeting is a market event. Mark those dates in your calendar. They're the most watched, most scrutinized, most consequential events of the year. Let's take a look at what you need to pay attention to in these meetings, because there are two sides, what they say and how they say it. Think of this as art and science. The science side is when they tell you what they're actually going to do. Are they cutting? Are they hiking? Are they staying even? Is there any QE or QT coming? Ultimately, this will always be the most important thing. But the nuance, or the art in this case, is how they say it. If I come to you and I tell you something and I say it with conviction and confidence, you're probably going to feel good about making that move. if I come to you and I sound timid and uncertain, you're probably going to be a bit hesitant and shaky, aren't you? Their tone will massively dictate how the market chooses to absorb the information. There's also nuance. Are they in agreement? Are there many dissents, which is basically members disagreeing with one another? The term you probably need to take away from this when thinking about their tone is hawkish and dovish. Quite easy to remember. Doves are lovely and beautiful and pretty, and hawks will rip your head off. Ultimately, this tells you if they're hawkish or dovish. Write those terms down too. If the Fed is concerned about inflation and they're leading towards higher rates, and this means they're hawkish. If they're confident and they feel the labor market and inflation is good, and they're even open to QE, this means they're dovish. Very easy to remember. Doves are great, hawks are scary. So when someone says they were dovish, this is typically very good for crypto. Markets are actually so attuned to the language used in these meetings that they can move on a single word. I've seen people psychoanalyze the body language of Jerome Powell, the head of the Fed, or sit down and reflect on a single word and seen it move markets by 5 or even 6%. So it's key you learn to read the tone, or find someone who knows how to read the tone, because it's not just the numbers that matter, it's the tone. Another key term for you to pay attention to at these meetings is called the dot plot. We've already discussed how important rate cuts are, and of course markets move, things change. The dot plot is essentially a chart published after every FOMC meeting that shows exactly what is expected to happen with rate cuts. There's no guarantee, as I said, because these things change on a dime. But each dot basically represents the Fed's anonymous view of where interest rate cuts or hikes should be at the end of each for the next couple of years. So if you see lots of dots clustered high on the chart, that tells you most Fed members think rates should stay elevated. As dots shift lower, that means people are confident that rates should go down. And the more distant they are from one another, that should concern you a little bit, because it seems they're not very aligned. The ultimate thing you want to see is lots of dots together, lower down the chart. Does that mean they're aligned and they're moving towards more cuts? This chart gives you a visual picture of what the Fed's collective thinking is. In short, dots shifting higher, bad and bearish. Dots shifting lower, good and dovish. Keep an eye on the dot plot meeting to meeting. Sometimes it doesn't change, but when you see huge moves in the markets, this can often throw things off. Because look, to go into a bit more detail, markets aren't stupid, markets are smart. Markets have a good idea of what's coming. And many sophisticated investors aren't thinking about the next cut, they're thinking about how many cuts and how many basis points are they going to cut by. Oftentimes markets are already pricing in 1 or 2 cuts, right, or hikes. So your goal is to get well ahead, which is why the dot plot is so important. Okay, this is great. You now understand the two entities in control and the two schools that govern the whole game. The government is fiscal policy, the Fed is monetary policy. Now, let's take a more in-depth look at the problems they're actually tackling. Everything we just covered, rates, QE, QT, the Fed's decisions, it all traces back to one underlying dynamic: the relationship between interest rates, inflation, and the job market. I already said, the goal of the Fed is to keep as many Americans employed as possible and keep inflation at a level where it doesn't throw the economy off. The economy can grow without prices going too high, where it starts to affect living standards. The issue is inflation and the labor market are always in contention. We already spoke about this. It's a type of dichotomy. When inflation goes up, the government needs to calm things down. But as they calm things down, it's bad for the job market. When the economy is doing poorly, they need to stimulate growth. They need people employed. But as they do that, naturally, inflation goes up. So there's this balance they're trying to constantly find. The ultimate goal as investors, especially when looking at macro, is to figure out where this tension lies and being able to read the Fed's next move before they come out and say it. Once you have this down, understanding the trilateral relationship between inflation and the job market and how rate cuts come to influence them, you have a cheat code to the whole game. First up, let's talk about inflation. Inflation is the rate at which prices are increasing in the economy over time. Too much money chasing too few goods, simple supply and demand. When there's more money in the system than products people care about buying, naturally inflation goes up. Same in the opposite direction. A small, stable amount of inflation, around 2%, is considered healthy. It encourages spending and investment. Below 2%, you have the idea of deflation, falling prices, which may sound good, but it's actually terrible because it causes people to stop spending. It slows the economy down. It can actually spiral into a recession. But then above 2%, especially well above 2%, and the Fed starts to get nervous and reaches for rate hikes. This is critical because, as we've already discussed, the Fed's entire decision-making process comes down to inflation and the job market. And inflation is basically the number one thing telling the Fed what to do. A key term you'll often hear us talking about is CPI. This means a consumer price index. That's the headline inflation number. It's reported monthly, and it basically measures a basket of goods for everyday people. Food, energy, housing, transport, clothing, the works. That's a number that gets reported in the news. The market's reaction to CPI is binary and immediate. A hot CPI print means that numbers came in higher than economists predicted. This means inflation isn't under control, and the Fed is more likely to hike rates or hold rates where they're at for longer. This is no good for investors. They risk off, they choose bonds over stocks and crypto, and expect crypto to pull back. Call it bearish. A cool CPI is the opposite. Inflation numbers come in lower, and the Fed has room to ease. This is good for crypto. People can risk on, and it's very bullish. Now, if it's too cool, this can be dangerous, as you can probably imagine. CPI is fascinating. I've seen many times where off a single print, Bitcoin has moved up or down 5 or 10%. It's key you stay in tune with these prints, and ideally, more importantly, you're front running these things. You're keeping an eye on other economic data to try and gauge and predict where prints are going to come in. I mentioned other inflation metrics. Now let's move on to PPI, also known as Producer Price Index. This measures what businesses pay at the wholesale level. Think raw materials, manufacturing inputs, goods before they reach consumers. PPI is a leading indicator for CPI. Naturally, if it costs more money to produce something, businesses have to sell at a higher price. A useful early warning that CPI is going to come in hot is where PPI comes in. If PPI is super cool, then CPI will be pretty cool. And the opposite too. PPI is too high, CPI will be high. But most people don't keep an eye on PPI. They stop at CPI. And that's what gives people like us an edge. Now, the least discussed of the three, and perhaps the most important, and something we monitor very closely, is called PCE. This is personal consumption expenditure. This is the Fed's preferred inflation metric to make its decisions. PCE actually adjusts for how consumers actually behave. Sometimes consumers are overly confident and inflation numbers aren't so great, but they're still willing to spend. And in some circumstances, things are cool, but for whatever reason, maybe from a social economic point of view, people aren't spending, even if they could. So sometimes, instead of looking at what people say, you have to look at what they do. And that's why it's so important to keep an eye on economic behavior. So this PCE captures that. CPI and PPI doesn't. So the Fed trusts this number more than the others because it's the most true in a sense. So the next time you see a CPI print and you wonder whether the Fed will react, check what PPI and then even more importantly CPE is doing. And just remember the number 2%. That's the Fed's stated goal. If inflation is running way higher than this, you know they're going to try and get this down, which naturally means they're going to have to hike rates, most certainly not cut them. When it's at this number or perhaps very close, the Fed has maximum room to do what it wants to do. And it's always going to try and stimulate, which always means rate cuts on the table and QE is on the table. The last thing worth understanding under this section is called the re-acceleration risk. inflation doesn't always fall in a straight line. It can come down, appear under control, and then rocket. This is often driven by energy prices, supply chain disruptions, wage growth, or new government spending addition. Which is why, even while inflation is improving, the Fed moves very cautiously. It can't rush to declare victory or make a decision, because on a dime, things could change. This is why markets often get very frustrated with cuts and hikes with rates, because you're expecting it and it seems so obvious, but the Fed can't just cut infinitely or hike infinitely. Things do change. This often leads to staggered cuts or hikes instead of consistent cuts and hikes. Now, here's a piece of context that makes everything we just covered more urgent. Inflation has now been running over the Fed's 2% target for over 6 years. That's why rates were raised so aggressively in 2022. The Fed wasn't overreacting, it was playing catch up, and we're still kind of at that point now. Inflation has been moving in the right direction for the last couple of years, but with the crazy conflict in the Middle East right now, we're at a stage where we could see inflation spike like crazy. Ultimately, we spoke about PPI and then CPI and PCE. Well, look, they've literally closed up. One second. The Iranians have closed up the Strait of Hormuz. With this closure, oil is less available. The relationship between supply and demand has changed. Demand is high, supply is low, which naturally means that the price of oil is going to go up. Now, oil is liquid gold. Pretty much everything relies on oil. If oil is more expensive, the price of producing everything is likely to go up, which means naturally the price for consumers is also going to go up. So inflation is top of mind right now and something you need to be paying very close attention to. The Fed is already behind, and if things do accelerate, they could force them into reversing their quota and goal of cuts and put hikes on the table. If you want to know what we think will actually happen and how we see these things playing out for the rest of 2026, that's something you can get inside Cryptoassets Pro. Just to summarize, what's literally happening right now is inflation was slowly improving. This was opening up the door for the Fed to cut rates, and CPI and PCE were coming down. This was fantastic, and the market was optimistic. Even us at Cryptoassets saw multiple rate cuts coming in 2026. But as US-Iran tensions increase, and as I said, the Strait of Hormuz being closed, and inflation looking like it's going to increase, the Fed's basically said, hey, hands off, we're not doing anything. And until the Fed starts acting, nothing's going to happen. The economy is not going to improve. There's no cuts. There's no easing. It's not going to happen. So kind of boring, but at any moment, something can change. If the Strait opens up and we're back on track. If tensions increase, things get a lot worse before they get better. The ultimate lesson I want you to take away from this section of the video is most of what I just described, the oil spike, the inflation risk, the Fed hesitation, the market already knows about this. It's already been discussed for a very long time. It's already been priced in. Smart people know what's going on. So things have already moved. The goal now is to look at what's coming next. And just reflect back and be real with yourself. If you knew this information several months ago, would you have held like you probably did, or would you have risked off? Because if you risked off, like we told you to, you'd be in a much stronger position. Continue to understand the chain of events better, and you will get so good, people will think you have insider information, but you're just more informed. Whether geopolitical escalations or a surprise PPI print, you can trace it forward to the likely output before the market fully prices it in. Because as efficient as the market can be, there are absolutely inefficiencies that can be exploited, especially with what we're seeing as of late, with markets reacting so ridiculously to Donald Trump and some of the tweets he's putting out. So it shows you, as evolved as the markets are, a lot of people are very irrational and are skipping out on what is actually being shown by the data. Okay, next up, we've discussed rate cuts, we discussed inflation. Let's move on to the job market, or the labor market, as my American friends choose to say. The Fed's mandate isn't just about inflation, it's also about the job market. And the job market is one of the most important, yet counterintuitive signals in all of macro. Now, listen carefully, because what I'm about to tell you sounds weird and paradoxical, but it's true. And very important you understand it despite the paradox. Strong jobs data can be terrible news for your portfolio, and weak jobs data is often the best thing that can happen for your portfolio. Here's why. A strong jobs report means lots of jobs added, unemployment falling. It means the economy is running hot. People are employed, they're spending, wages may be going up, and that sounds great, right? But here's the issue. All of this feeds into the inflation risk, which means the Fed now has less justification to cut. And as we know, cuts are bullish. So heck, if things get too good and the job market gets too good, they may actually need to hike to reverse this process. And you can spin this. A weak jobs report means people are losing their jobs, less people are applying for jobs, the economy's cooling. And in order to reverse this, the Fed has to stimulate. And they're going to do this by cutting rates, making it cheaper for businesses to go out and hire new people, which will then cause people to have more money and cause people to spend, which is good for crypto because there's more money flowing. So now you can see there's a delicate dance between inflation and jobs data. We actually want to see bad jobs data. We want to know people have lost their job. We want to know that businesses are losing money. We want this because, as bad as it sounds for regular people, it's good for our portfolios, at least in the short term. So, on a human level, a booming economy may seem good, but a booming economy means the Fed is less likely to cut, which means tighter economic conditions, which is bad for risk assets across the board, and in particular, crypto. So that's why macro-aware investors sometimes appear to be rooting against strong economic data. They're not bad people, they just understand the chain of events. Strong economy, Fed stays hawkish, bad for crypto. Cooling economy, Fed becomes dovish, great for crypto. Let's take a look at the actual data points that come out that we pay attention to. First up, we have non-farm payrolls, which is NFP. This is measured by the US Bureau of Labor Statistics, and it measures the number of jobs added to the US economy from the previous month. It's one of the most watched, most important market-moving data releases in all of macro. Mark it alongside CPI and PCE. Understand what the consensus expectation is before it drops, then watch what comes in. Next, we have the unemployment rate, which is reported alongside NFP. This is the percentage of the labor force that's actively looking for work but unable to find it. The Fed is watching this very, very closely. It's a great proxy for understanding economic health. And it's a huge consideration when looking at the dual mandate. You also have wage growth. This is also reported alongside NFP. This measures how fast wages are rising across the economy. This matters because rising wages feed directly into business costs. As businesses are paying more for labor, they charge more for their goods to offset this. This means wage growth equals higher inflation. And sticky wage growth is one of the main reasons inflation is hard to kill, even when the other pressures ease. So look where we are now. You now understand inflation, the job market, the Fed is using interest rates to kind of manipulate the two to keep them at a healthy point. It's a balancing act, and it's not easy. It's very difficult. They have a borderline impossible job. So those are the two sides of the mandate. Raise rates too aggressively to kill inflation, you could push the economy into a recession. Unemployment spikes, growth collapses, cut too early to protect the jobs, and you risk inflation reaccelerating. This tension between price stability and employment is the core drama of every Fed cycle. Reading where the balance tips at any given moment is how you anticipate the Fed's next move before the market. Right, let's bring them all together one last time to make things crystal clear in one single picture. What we're about to describe has a formal name called the economic cycle. Now, this really will take you back to the textbooks, but hopefully now that you have skin in the game, it means a lot more. You probably remember your teachers calling it the boom and bust cycles. It's the same thing, and it's the most important reoccurring patterns in all of finance. This runs across years, decades, cycles, probably as long as markets have existed. The goal is to always understand where we are in this cycle. If you can figure out where we are in the cycle, it's almost a non-factor.
If you can assess where we are in the cycle, you can shift the odds dramatically in your way. It's one of the biggest skills you can develop as an investor.
So let me walk you through it. Let's start with this. Stimulus enters the economy through government spending, rate cuts, QE, or perhaps all of them simultaneously. Businesses can then invest because they have more money to borrow. People spend more. Employment rises. Wages grow. The economy heats up. This is the boom. However, when it gets to the point where there's too much money chasing too few goods, inflation rises too high. The Fed starts to get uncomfortable. The Fed raises rates to cool things off. Borrowing gets more expensive. Businesses slow investment. Consumer spending pulls back. The economy is now cooling. Unemployment starts to tick up. This is the bust beginning. As the economy cools, inflation falls back towards target, but unemployment has risen toward levels the Fed finds uncomfortable now, and the Fed starts to consider cutting rates. Fed cuts, borrowing becomes cheaper again, stimulus re-enters, the boom begins again. Simple cycle, old as time itself. The cycle doesn't play out over weeks, plays out over years, sometimes cycles take decades. The post-2008 stimulus cycle ran all the way through 2022. That's 14 years, which was all punctuated by the COVID 2020 shock and recovery. This cycle will never end. That's what our system is built on, for good or for bad. All of it moves on a pendulum.
Figure out where you are in the pendulum and give yourself a real edge.
So where do you think we are right now? Are we in a boom phase or are we in a bust phase? Boom phase, rates low, QE running, economy heating up, risk assets, crypto moving up. Or we in a bust phase, rates rising, QT running, economy cooling, that's when crypto's down. Approaching the pivot, the Fed is shifting from tightening back to easing or vice versa. From tightening to easing is historically one of the most profitable moments to be positioned in assets like crypto. Learning to read where you are in this cycle and specifically finding the pivot is one of the highest value skills any investor across any asset class can possess. Everything else we cover in the service is of helping you do exactly that. Everything we've covered so far has been primarily US focused. US government, the Federal Reserve, US inflation data, US market, and that's appropriate. As I said, the US is the world's largest economy, and the dollar is the global reserve currency. That's what people trade in, and the Fed sets the tone for the entire world, the global markets. But the US can't act in isolation, and if you want to have a truly complete understanding of macro, you need to zoom out to the global level, because it's at the global level that we find some of the most powerful forces affecting crypto. Let's start with the dollar index. I want to show you something, and I want you to actually do this, not just watch me describe it. Open TradingView, it's free. Pull up the US dollar index, the ticker is DXY. Overlay it with Bitcoin, and now invert one of them. They almost mirror each other. When the dollar strengthens, crypto weakens. When the dollar weakens, crypto flies. One of the most consistent, repeatable signals in the entire crypto market, and most retail investors have never looked at it, not even once. The dollar index measures the dollar's strength against a basket of other currencies, such as euro, yen, won, British pound, Canadian dollar, the works. Dollar up means the dollar is strengthening, which means demand for the dollar is up, opposite to DXY down, that means we're weakening. The three primary reasons the dollar being stronger negatively affects crypto is risk assets are priced in dollars. So a stronger dollar makes them less valuable proportionately, and it makes it more expensive for international investors to buy these assets. 2, a rising dollar index signals tightening financial conditions. The same forces that push it up, Fed hiking, global uncertainty, capital fleeing to safety, crushes risk appetite. 3, dollar index increases the real burden of dollar-denominated debt globally. Emerging markets get squeezed. That stress ripples outwards. In 2020, the dollar index collapsed. The biggest crypto supercycle in history followed. The relationship is not subtle. In 2022, the dollar index hit a 25-year high around 114. Bitcoin fell from 68,000 to 16,000. Add the dollar index to your watch list. Dollar up, terrible. Dollar down, bullish. Now, let's zoom out further to what may be the single most important multi-year indicator for all of crypto. Now, I will say this is arguable. I've spoken to plenty of analysts that say this is way overblown, but I'd be dismissed if I didn't discuss it in a macro video. This is M2. This is the broad measure of money in the entire global financial system, cash, deposits, money market funds, all major economies. When central banks globally are expanding, the Fed, the ECB, the Bank of Japan, the People's Bank of China, M2 up. More money in the system, as you can already tell at this point in the video, equals more money looking for a home. Some of it will find its way into crypto. When they tighten simultaneously, as in 2022, M2 contracts. Less money in the system, less money potentially flying into crypto. Crypto feels it first, and disproportionately, Bitcoin has historically had a strong correlation with global M2 expansion. An important nuance, M2 is almost always increasing. It doesn't go down. Money's always coming in. You've always got a bit of a printer, and you're not really using the paper shredder. So the question isn't really the M2 as a whole, it's are we accelerating or decelerating? Money supply will always go up, but how fast is it going up? A faster rate is typically bullish for crypto and other risk assets. A slower rate means bearish. The signal is not the direction, the signal is the pace of change. Now we have the Fed balance sheet. The Fed balance sheet shows all the assets it owns, primarily government bonds purchased through the QE process. When the balance sheet is growing, the Fed is adding money to the system. When it's shrinking through something like QT, money is being removed. Watch the direction. Growing equals constructive, shrinking equals a headwind. China matters here too. When the People's Bank of China eases, cuts rates, injects liquidity, that expands M2. Chinese stimulus cycles have historically preceded crypto rallies, so keep a very close eye on China for both signals. Stimulus is a tailwind, stress is a headwind. Okay, right, now we've talked about the Fed, we've talked about rates, we've talked about inflation, we've talked about employment, the dollar, global liquidity, and all of it feeds into one thing: risk on, risk off. Risk sentiment describes the overall attitude of investors at any given moment. Are they willing to take risk in pursuit of returns? Or are they pulling back, seeking safety? Think of it as a spectrum. At the safe end, you have cash, which is why we said when the dollar index is up, crypto is usually down. You go from cash to government bonds, to investment grade corporate bonds, then equities, then high yield bonds, then emerging market assets, and at the very far end of the spectrum, you have crypto. And don't even get me started on crypto. You're going from the likes of Bitcoin all the way to a meme coin. When investors are in risk on mode, the economy is typically growing, inflation's under control, the Fed is accommodative, sentiment's positive, and capital is flowing across that spectrum with a few rotations along the way. Literally everything is up when things are risk on. And it's not complicated. Risk off is obviously the opposite. Recession fears, geopolitical shocks, banking crisis, surprise inflation prints, unexpected Fed hawkishness, capital's flowing in the opposite direction. People are looking for safety, cash, bonds, gold, away from equities, a country mile away from crypto. That's why crypto falls harder than equity in a risk-off environment. And I said it at the start, but you're seeing it in real time with the geopolitical chaos in the Middle East. Trump is timing his attacks. So he lets the market close on a Friday and he starts heating up the aggression. The only thing you can sell at that point is crypto. So that's what's being sold off. And then Sunday night or early Monday before markets open, hey, everything's cool, we're reaching a deal. So the stock market remains intact. Disgusting, ridiculous, crazy market manipulation, but it's not surprising. Typical thing to remember here is just use common sense. Anything that's going to cause more fear for investors is going to push you risk off. And anything that's going to create euphoria and greed is going to push you risk on. One thing I will say from experience is risk on tends to happen gradually over time. It seems like a build-up of different events. Risk-off moves are typically fast and violent, especially in a volatile market like crypto. Think about October 10th and 11th, FTX collapse, the Luna issue, and so many more. The collapse of Silicon Valley Bank. These things happened almost overnight. Whereas for things to go risk-on, you need so many different factors coming positively together. So risk-on takes time. Stay patient. Risk-off happens overnight. Be very, very careful. Right. So you now have all of the concepts. Let me show you what they look like in the real world. We're going to walk through two scenarios, the most supportive macro backdrop and the least supportive macro backdrop. And we're going to use real life modern examples, specifically in crypto. Both happened, both are real, both happened in the last 5 years. And seeing them side by side will give you a way clearer picture of how it works in reality. COVID-19 pandemic, once again, terrible for the world, but global economy shut down. The US economy contracts by over 30% on an annual basis in the second quarter, the sharpest contraction in modern history. And then governments and central banks have to respond to this, and they do everything in their power to do so. Here's what happened across every single macro indicator we've covered today. Simultaneously, might I add. Federal Reserve cut federal funds rate to essentially zero. March 2022, not gradually, overnight. And then launched one of the most aggressive QE programs in history, buying over $120 billion of assets every single month. The balance sheet expanded from under $4 trillion to nearly $9 trillion in 2 years. The US government deployed trillions in fiscal stimulus, business loans, enhanced unemployment benefits. The total fiscal response ran into tens of trillions all over the world. Global central banks followed. ECB launched its own programs. China did the same thing. The Bank of Japan expanded its already extraordinary monetary policy. China, once again, injected liquidity into the banking system. Every major central bank in the world was easing simultaneously. Global M2 expanded at the fastest rate in decades. Money was being created at a pace the world had never seen. The dollar index crashed massively. Exactly what you'd expect when the Fed cuts rates to almost zero and floods the system with money. Inflation was initially low. The pandemic had crushed demand. This gave the Fed justification to keep easing, keep cutting. Even as the recovery accelerated, people were still out of work due to the conditions of, the world. Risk sentiment shifted from extreme fear in March 2020 to one of the most bullish, exuberant environments in modern financial history by 2021. Government stimulus checks literally went directly into people's crypto exchange accounts. Retail participation reached record levels. Every single indicator aligned. Maximum liquidity, minimum rates, massive fiscal stimulus, weaker dollar, expanding M2, risk-on sentiment at crazy high levels. The result, Bitcoin from less than 4,000 to over 69,000 in less than 2 years. Ethereum went from less than $100 to nearly $5,000 in that same time period, and the broader crypto market followed suit. Billions of dollars flowing around on these little things called NFTs, which you may remember. Was it luck? Was it any crazy innovation? Was it project fundamentals improving by several thousand%? No, it was simply the change in macro backdrop. Every green light, every leading indicator pointing in the same direction, all tied together. But here's the part the history books don't put on the highlight reel. All of that stimulus, the rate cuts, the QE, the fiscal checks, the money creation, all of that at the unprecedented level we saw didn't just drive prices higher. Things went too high. CPI went from sub 1% in 2020 to over 9% by mid-2022. Same conditions that created the greatest crypto bull run in history has set it up for one of the most monumental crashes in financial history. Destructive bear market that followed, I'll never forget it, and I lived it. And fortunately, being around people who understood things from a macro level, we knew this before it happened. Now, the other side, 2022. Same checklist, every indicator reversed. By early 2022, the inflation caused by all that stimulus was running at a 40-year high. CPI over 9%. Remember, the goal is 2%. The Fed had been way too slow to respond. They'd called inflation transitory for over a year, and now they had to move fast and hard. The Federal Reserve began the most aggressive rate hiking cycle in over 40 years. 0 to 0.25% in March 2020, all the way to 5.25% by mid-2023. 12 consecutive hikes. The fastest sustained rate increase in modern history. Simultaneously, the Fed reversed QE and began shrinking its balance sheet, removing money from the system that it spent 2 years injecting. The US government had pivoted from record stimulus to record tightening. No more checks, no more emergency programs. The fiscal tailwind became the ultimate headwind. Global central banks followed. The ECB, the Bank of England, and others began their own rate hike cycles. Simultaneously, the most synchronized global monetary tightening in decades. As you can imagine, M2 contracted, money removed from the system, the fastest being added, dollar index surging to a 20-year high around 114 as the dollar strengthened. The Fed remained hawkish until mid-2023. Risk sentiment collapsed. I had never seen a larger drop in sentiment ever. We at Cryptoassets watched tens of thousands of people go from being crypto fanboys to running away forever. So much money was lost. Bitcoin from 69,000 to 15,000. Many altcoins dropped 90 to 99%. We saw Solana from $200 plus to $5. Obviously a bunch of other factors, but still absolutely insane. This is why Terra Luna, 3 Hours Capital, FTX, these things collapse not out of coincidence, but because of the insane leverage in the system. The macro environment exposed the nonsense. The part that stings most as someone who's been in the game for a long time is many of these projects have genuine tech, genuine communities, genuine use cases. But when macro moves, there's nothing you can do. You have to be prepared for it. The same way we as investors have to stay safe, the builders of these businesses have to be safe too. You cannot overextend yourself or you will be caught offside. So now you've seen the perfect macro backdrop and the worst macro backdrop. When you look at 2020 and 2022 side by side, and you look at the way they played out, you now understand the importance of macro and why the majority of people, especially retailers, are absolutely shafted in this space. Okay, now I want to turn to the current macro backdrop. Now this video is being published in April 2026 and things can move. And we are in unprecedented times when it comes to macro right now. And I want to be honest with you, we know what we're looking at, but it is very tumultuous and it's changing very quickly because it's more complex than any other market I have ever seen. So the two other examples are very clean. Today's environment is very nuanced and must be approached with caution. So let's shoot straight. Global liquidity, very, very mixed. We've come out of extreme tightening from 2022. Rates are coming down, but the Fed's cautious. They can't rush. M2 has expanded again, but the rate in which it's expanding, it's not set. It's not moving in a straight line. It's flip-floppy. The Fed is cautiously easing, but there are talks of rates on the table, especially if the US cannot resolve this Iranian oil issue. There are lots of members dissenting, which means there's disagreement across the Fed. We also have the Fed chair, Powell, being replaced as of now too. So it's trippy times with the Fed, absolutely. Inflation is improved, but it's not beaten. CPI and PCE have come down significantly from 2022 peaks, but it's still well above the 2% target and has been for over 6 years. We're around 3% now. Into 2% is not going to be easy. So the Fed is prompted to take some serious actions here. The re-acceleration risk we spoke about is very real. The Middle East situation and the elevated prices, it's terrible. I cannot undermine the significance of it and why we are watching macro so closely at Cryptoassets. The dollar index is very elevated. It remains stronger than it was throughout most of 2020 and 2021. That's a persistent headwind for crypto. It's not fatal, but it's real. A sustained weakening would be one of the most bullish things that can happen for crypto, and we're going to have to see that before we were to switch to risk on mode. Speaking of risk, sentiment is cautiously optimistic but fragile. Equities pushed to new all-time highs, so did gold. Crypto struggled for a while, but now we expect things to pull back quite heavily. We're going to have to see some of these factors shift before sentiment switches, but sentiment does shift very, very quickly. A couple of events and everything changes. Look, ultimately, the thing I have to tell you is to stay ready, watch these signals closely, be ready to respond when the backdrop genuinely does shift in a more ambiguously positive direction. When it does, and it will, as we said, these are cycles. If you know about it, you'll make money. And that's the entire point of this video. Okay, one last thing before we close, now that you're macro sophisticated. Hope you enjoyed the masterclass. So macro is one of the most important things for you to follow, but it's not the only thing. Think of the finance game as a stack of layers. Macro's foundation tells you whether the environment is working for you or against you. But on top of this, you have technicals. Where in the move are we? If you think about a big cycle, that's macro. The smaller cycles within it, that's technicals. Then you have mechanics, which is looking at why price is behaving the way it does, typically due to what traders and investors are actually doing. Then you have the fundamentals, what assets are actually worth your time. In a market where thousands of tokens are being launched every week, how do you get behind a select few? So for you to win in this game, you need to stack these layers. Macro, technicals, mechanics, which also includes on-chain, and then fundamentals. But yes, absolutely. The reason we're launching this video first as part of our investor's guide to the world of is because this is the underpinning. So now, congratulations, you understand the government's role, you understand the Fed's role, you understand the importance of interest rates, QE, QT, FOMC, and if they're hawkish or if they're dovish, the dot plot, the pivot signals. You understand the relationship between interest rates, inflation, and the job market. You understand the economic cycle and the bull and bear markets. You understand global liquidity and the dollar index. And you see where we sit right now in that market. You've seen the perfect backdrop. You've seen the worst backdrop. I have prepared a 6-question framework for you to review every single month to make sure you're on track with macro. But I've decided halfway through recording this that I'm going to put that in its own video, something for you to come back to and maybe treat more like a worksheet or an actionable thing to do. Subscribe, hit the bell. Thank you for watching.